What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Okay, happy Friday everybody. To start with, let's touch on several major economic and financial developments in China from the last few days. And first up this week, analysts at Nomura Holdings Limited wrote in a note for clients, quote, "As China, the world's second largest economy and the largest manufacturer, has been facing a rising risk of recession since mid-March, global markets may still underestimate the impact because much attention remains focused on the Russian-Ukraine conflict and US Fed rate hikes." End quote. In a separate note, Nomura published its own survey data too, which found that 45 Chinese cities with a combined 373 million people have implemented either full or partial lockdowns as of Monday this week. This is up from 23 cities and 193 million people just a week earlier. The analysts observed that the 45 cities account for more than 1/4 of China's population and roughly 40% of China's GDP. And even more cities are included when you take into account restrictions. Next up, over the weekend, we discussed the limitations of monetary policy. That is, the limitations of making credit available to stimulate the economy. Economists at Bank of America expressed a similar feeling in a research note yesterday, expressing that, quote, "Credit demand is so weak and there is abundant liquidity in the interbank market, and the banks are having trouble lending them out," end quote. And that since credit demand is very low, adjusting interest rates and cutting reserves isn't the most effective form of monetary policy for China. Despite this, Goldman Sachs wrote in a note on Thursday that they expect the People's Bank of China to deliver a 50 basis point RRR cut and potentially also an interest rate cut in the next few days. That was in the next few days from Thursday. And indeed, the State Council, China's cabinet, hinted strongly on Wednesday that there would be a reduction in the RRR. However, today, Friday, the People's Bank of China, China's central bank, announced that it would not be cutting interest rates, nor would it be injecting more liquidity into the economy. This is very much an ongoing development, and we will touch on it more over the weekend. Over the last few weeks, we have been discussing the recent trend of overseas investors offloading holdings of Chinese bonds. The last video examined this trend in the first 2 months of this year. We now know that global investors also ditched Chinese bonds in March at a record pace due to China's vanishing yield advantage over the United States and investor concerns surrounding PRC vulnerabilities to Western sanctions, increasing the cost of risk. According to data published this week from China Central Depository and Clearing Co. Limited and Shanghai Clearing House, foreign investors held 3.88 trillion yuan, $609 billion of bonds in China's interbank market as of the end of March, over 110 billion yuan less than at the end of February, representing the second monthly decline in a row. Foreign holdings of Chinese government bonds declined 2.09% in March to 2.43 trillion yuan. We covered that earlier in the week. Despite all of this, however, analysts both domestically and overseas are remaining optimistic that inflows will likely resume in the second quarter. Analysts with Yicai also point out that the scale of the decline is relatively small compared with overseas investors' total holdings of Chinese assets. However, they may be a little premature. We need to first see how the many economic headwinds China is facing are managed over the next few months before we can make a decision as to how optimistic we should be that inflows of capital will return in the second quarter. Though ultimately, while capital outflows do create issues for policymakers, with foreign investors' holdings accounting for only 3% of China's 136 trillion yuan bond market, they are unlikely going to trigger a major crisis by themselves. And next up, according to a statement made by China State Railway Group Co. Limited, China is currently running fewer than 3,000 passenger trains a day, which is down more than 70% from quote-unquote normal times, though the national railway operator does not specify the period of comparison. The operator explained that this drop is due to lockdowns and restrictions across the country. Now, while we're on this theme, Chinese financial media outlet Caixin Media reports that according to G7, an IoT platform that tracks millions of trucks in China, road freight traffic nationwide fell 29% year-on-year for the week through last Sunday, marking the fourth straight weekly drop. And one more thing while we're on economic and financial developments, in yet another potentially pessimistic sign for investor confidence in Chinese American depository shares. According to exchange filings, the Los Angeles-based Daily Journal Corp, a newspaper and software company previously chaired by billionaire investor Charlie Munger, sold half of its holdings in Alibaba Group Holdings Limited in the first quarter of this year. In February, Alibaba reported that its fourth quarter net profit attributable to ordinary shareholders fell an astonishing 74% year-on-year. Now, those are the economic and financial updates from the last day or so. Let's move on to the escalating situation in Shanghai. As always, guys, if you enjoyed the content, don't forget to hit the like button. It's a huge help for a small channel like this. And for anyone who wants to go the extra mile and help support the channel and make it sustainable, my Patreon, Buy Me a Coffee, and crypto links are in the description below. As always, thank you so much, everyone, for your ongoing support. Let's continue. After over a month and a half of lockdowns, the residents of the northeastern city of Changchun may finally have some good news. At a local government press conference on yesterday, it was announced that Changchun, capital of northeast China's Jilin province, has cut off all COVID-19 transmission chains out of its quarantine areas. As such, the city may be able to start opening back up. Shanghai, on the other hand, has not received this sort of good news, with new officially recognized cases in the tens of thousands by the day, including hundreds being discovered outside of so-called closed-loop quarantine facilities. It is still difficult to know when case numbers will stabilize, let alone begin to decrease. Food supply issues remain in many parts of the city too. Now, some Chinese experts and officials are saying that cases may peak this week, though at this point it's hard to say, and we will see over the next few days. With comments and videos posted online, we can see that frustrations among some Shanghai residents is boiling into anger. In some cases, we can even see small-scale, by China standards, demonstrations and protests on compounds and on the street. Yesterday, Thursday, videos showing Shanghai residents being dragged off by officers in medical suits went viral on Chinese social media before censors could move on them. Then, soon after, these videos were spread onto international social media. Some of you may have already seen some of these videos. In the videos, we can see residents involved in scuffles with police and security officials and what appears to be some arrests. In one video in particular, one security officer is recorded saying to a demonstrator, quote, "This is all because of the international situation. If you continue to make trouble like this, there will be no hope for China. We are going to go to war with the United States, don't you know? Only the party can save China now." End quote. The officer was likely just speaking off the cuff, but the statement is disquieting nonetheless. Meanwhile, apologist state media coverage of China's COVID policy continues. State-run Xinhua on Thursday published a commentary saying that China refuses to, quote-unquote, lie flat, and that the country does not give up on patients. In another article, readers are warned that the country's medical system risked breaking down in the event of mass COVID outbreaks. Other articles assure readers that the economy will be okay and that the damage caused by these lockdowns will be modest and only short-term. As we expressed yesterday, this jump in articles defending the policy choice of Beijing suggests that policymakers are increasingly aware of growing public dissatisfaction towards these policies. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.